We have a raised hand from Mr. Ranjan. Maybe I can ask him to talk. Ranjan, you can unmute yourself and share your question. You're not audible to us.
Am I audible, sir? Now?
You're audible
Yes,
now.
Yes, sir. Sir, is there any provision for subsidized rate of interest for priority sector lending here?
See, the priority sector lending rates are normally subsidized because the banks are under obligation to give priority sector lending.
That's
However, when the
governed.
banks,
That's already governed by separate systems within RBI. I think this particular direction will not deal with the subsidization. But yes, there is
yes,
subsidization in MSME loans. There's subsidization in other schemes as well.
yes, and this
Thank you.
subsidization, in fact, comes because of lower compliances like statutory cash reserve ratios, and those are not applicable or lesser applicable to priority sector lending. Therefore, the banks can afford to extend priority sector loans at concessional rates.
Good morning, everyone, and welcome back to our weekly webinar series. At episode number 160 today, we are once again continuing the discussion on the RBI draft regulations that came in and discussing another important one. Over to Anil, sir.
Thank you, Ankit. Welcome to episode 160 of AAA Weekly Webinar Series. Last webinar, we discussed the third resolution framework, which is proposed by Reserve Bank of India, as where there is a role for insolvency professionals and insolvency professional entities. So, and we actually received a lot of response and a lot of audience for that particular draft directions and that episode, which was 159th episode. So therefore, we thought that our audience, which is primarily the insolvency professionals, IPE, advocates, bankers, the employees of ARC, and also the officers of NBFCs, and so all these, they all are interested in this kind of a larger framework which comes from Reserve Bank of India. So therefore, we thought of this co-lending RBI draft directions, which was released on 9th of April 2025. And this was regarding co-lending arrangement. The co-lending arrangement is something which is a kind of a unified framework for collaborative credit delivery. And we would be discussing today the regulatory evolution, how this RBI co-lending arrangement in fact started, what was the logic behind this, and what is the difference between the existing directions or existing framework vis-a-vis what is proposed now. So when we see the this particular RBI co-lending arrangement draft directions, this is actually this is basically, let us understand what is the aim of these directions. The aim is to codify and unify the regulatory regime for co-lending and loan sourcing and service arrangements amongst regulated entities. And the draft directions, in fact, will replace fragmented frameworks, especially in 2020 when this was initiated, and guidelines on the co-lending for priority sector lending, and then extending the coverage of co-lending arrangements to a broader arrangements, including digital lending and also default loss guarantees. Now, these directions, in fact, as you understand, the RBI, whenever the RBI gives such kind of directions, this comes under Section 21 of Banking Regulation Act, Section 35A of Banking Regulation Act, and also as per the Chapter 3B of the RBI Act. So this is what the RBI has the power to make all these directions. Now, when we see the evolution of co-lending framework in India. In fact, it started in 2018 when this co-origination of loans, and that was specifically meant for priority sector lending. Now, in 2018, RBI framework on co-origination of loans, in fact, that marked the first regulatory attempt to formalize partnerships between banks and NBFCs for private sector lending. Now, the private sector lending can be lending to agricultural sector. It can be for even the MSME. It can be a small and it can be even very small loans. So, which is a micro financing. So these are all kind of priority lending loans where the infrastructure required is very high and the deployment of funds is low. So RBI came up with that kind of regulation that this can be a collaborative effort between one, the company which is doing the sourcing, which is doing the servicing, and also some kind of investment from their own pocket. And major investment can come from larger banks or larger NBFCs. So that was the original intent. So therefore, this was priority sector. This was made for priority sector lending. And then in 2020, the co-lending model introduced by RBI by the circular dated 5th of November 2020. And that was applicable to banks excluding small finance bank, regional rural bank, and NBFCs. It was applicable to NBFCs, but it was applicable to all kind of NBFCs, including house finance companies. So this was a kind of back-to-back booking of banks, but remained restricted to priority sector lending only. It remained restricted to priority sector lending only. However, now when we see these draft directions from RBI dated 9th of April 2025, it actually is now introducing a comprehensive legal structure covering all sectors and regulated entities. When we say all sectors, it is not restricted to the priority sector lending only now. Then regulating co-lending, co-sourcing, servicing, and also the digital structures with default loss guarantee up to 5%. Now, it is very important that we understand what is co-sourcing, what is servicing, and what is kind of a customer interaction. All this we would be discussing today. And then, however, in this master directions also, the focus is on priority sector only, but allowed for more structured risk and revenue sharing. Clearer escrow mechanism is now introduced, and introduction of a requirement of a master agreement between partners. Now the NBFCs will actually remain a customer-facing entity, with banks taking their loan share on back-to-back basis. However, the co-lending mechanism, the co-lending model still excluded non-public priority sectors and did not address emerging, and it was not addressing the earlier it was not being addressed. The digital lending was not being addressed. So let us see now what exactly the difference is. In brief, we would be discussing what are the differences, what are the differences in the existing guidelines and the new draft guidelines, which can be released or notified anytime. First of all, let us understand the scope of application. The scope of application, earlier it was restricted to private sector only. Now it applies to all sectors, priority and non-priority sector. Now this co-lending directions would be applicable to, however, there is a restriction that it cannot be applied to a loan of more than 100 crore to one entity. So therefore, it can be, the co-lending is applicable to all those loans which are less than 100 crores. We will come in detail in subsequent slides. Now, what are the entities, regulated entities, which are covered under these directions? One, earlier it was only applicable to scheduled commercial banks, excluding regional rural bank and local area banks, and also the small finance banks, and all NBFCs were covered, including housing finance. But now this coverage of these directions are expanded to include all India financial institutions also, along with the banks and financial institutions, digital lending and fintech companies. It was not there. There was no clarity, but now explicitly allowing the digital sourcing, and which aligns with the RBI 2022 directions for digital lending guidelines. Coming to the loan cap, earlier there was no upper cap specified for the coverage, but now it is actually loans which are above 100 crores under consortium or multiple banking arrangements are excluded from co-lending arrangement. The no formally defined limit regarding first loss default was there, but now this is the the default loss guarantee, which is permitted up to 5% in accordance with the RBI's 2023 guidelines. That is also now specified. Fund flow mechanism, the mandatory escrow mechanism, not clearly linked to the ICA, but now escrow system, which is mandatory, with enhanced clarity on disbursement, repayment, and fund flow auditing. That is what is now proposed. NPA classification, like it was institution-led and the NPA classification by respective regulated entities. Now it is borrower-level NPA classification, compulsory for participating regulated entities in the co-lending arrangement. It is now borrower-level NPA classification, which is compulsory for all participating regulated entities. And then the kind of key fact statement is prescribed now. Then the annual percentage rate computation is also supposed to be disclosed. So these are some of the disclosure requirements. And the customer interface. Customer interface is now defined in the master agreement. It has to be defined in the master agreement, and the borrower's consent is required for changing the customer interaction. Master agreement would be, it will include audit provisions, the default loss guarantee provisions and terms, grievance escalation structure and mechanism, and also business continuity plan. Business continuity plan is like, even if there is the co-lending arrangement is in fact revoked, but still all those customers will continuously get the service from the same person who actually took the duty of interface. Therefore, now it is governed by master directions, which is transfer of loan exposure. Like with regard to the transfer of loans, it will be governed by master directions, transfer of loan, and with mutual consent. That is what is the auditing is proposed. Internal auditing, statutory auditing is proposed. There are some disclosure obligations which are proposed. Now, this draft regulations sorry, are applicable to a broad spectrum of regulated entities participating in co-lending. Co-lending is one word which is actually jointly lending and jointly contributing the funds. That is co-lending. Then is sourcing. Sourcing is like the one entity is sourcing the client, sourcing the borrower, doing the marketing efforts, and then servicing of loans. And the other is servicing of loans. Now, the servicing of loan is kind of all documentation, and then all kind of grievances, and even ultimately recovery also. So these are the three kinds of co-lending mechanisms or arrangements. One is the pure servicing or pure sourcing, and the other is co-lending with clearly defined inclusions and exclusions. So these directions aims to bring uniformity oversight and prudential discipline to a wide range of collaborative lending models. The regulated entities, now it would be covering all commercial banks, excluding small finance bank, local area banks, and regional rural bank. But it will include now all India financial institutions. It will include all non-banking financial companies, including housing finance companies, infrastructure finance companies, investment and credit companies, and also microfinance NBFCs, factoring services NBFCs, peer-to-peer financing NBFCs, and mortgage guarantee companies. All this will be applicable. Any entity which is not listed as a regulated entity in these directions would not be able to participate into co-lending arrangement. That is also clarified. Now, the co-lending transactions which are covered by these transactions are those where there is a revenue sharing, there is a risk sharing, and also responsibilities sharing. Whenever out of these three, anything which is being shared, it will be covered under these directions, and it will actually be co-lending arrangements involving joint participation by permitted regulated entities in funding a loan or loan portfolio, and they shall also apply to. See, they would also apply to loan sourcing arrangements where one regulated entity or non-regulated entity sources loan for another. Now, this is very important that these co-lending transactions would be covered even if one party, which is a sourcing arrangement party, which is a service provider, in fact, in case of that, it would be non-regulated entities also can become a loan sourcing arrangement partner. Loan sourcing arrangement partner can be a one particular company which is not lending, which is not even an NBFC, but they can actually provide the loan sourcing services. Then servicing arrangement where the servicing is outsourced without fund commitment. Now the servicing can be like even filling up of the form, doing the KYC, going to the customer premises, taking all the signatures, and then attending to all their queries, and then even management of all their grievances, and finally recovery. That is also covered under these transactions also would be considered as co-lending transactions. Then digital co-lending models subject to default loss guarantee guidelines in June 2023, those also would be covered, and the default loss guarantee backed arrangements with a cap of 5% of the portfolio will also be covered. Now, specifically, what is excluded specifically from the co-lending arrangements? One, digital lending platforms without co-lending are not covered under these transactions. Business correspondents is another way of doing business. They are also not covered under these directions. And loan participation, which is the master direction on transfer of loan exposures, that is master directions on transfer of loan exposures dated 24th September 2021. So these are all excluded. Now, let us understand what is the business correspondent. In fact, business correspondents are individuals or entities authorized by banks to offer basic banking services on behalf of banks, especially in remote or underbanked areas. Without opening a full-fledged bank branch, in fact, the business correspondents, they act as agent of the banks to promote the financial inclusion. They would actually provide the services like account opening, depositing of money, withdrawal of money, and also money transfer to the extent of handling cash on behalf of the clients. That is what is the definition of business correspondents. And there are many business correspondents which are presently working in India and especially catering to those areas where there is no very active banking facility available. So these agents, they actually go to villages, they go to those places and also assure banking, and they also open the bank accounts. That is where the business correspondents are not included in the co-lending transactions. So that is not a co-lending transaction. That's what I just wanted to say. So this applicability of these directions, as we have already said, is to commercial banks, specialized NBFCs, all India financial institutions, and NBFCs, and the co-lending transactions which are covered: joint participation arrangement, loan sourcing arrangement, servicing arrangement, and digital co-lending models. And important conditions for co-lending. Important conditions for co-lending are compliance requirement. Any co-lending arrangement not compliant with these directions is prohibited unless specifically permitted by RBI. Participation restrictions: the regulated entities are not not included in the list of permitted regulated entities, cannot enter into any co-lending or sourcing with the any regulated entity or non-regulated entity. Sourcing arrangement, even sourcing only without fund commitment are subject to these directions. So therefore, outsourcing or sourcing structures, even without funding, are regulated under these directions to ensure risk, containment, governance, and borrower protection. This comprehensive approach aims to prevent regulatory arbitrage and ensure consistent standards across all lending models. Some of the definitions which are very important. What is co-lending arrangement as per these directions? The co-lending arrangement is a joint lending setup between permitted regulated entities involving shared funding, risk and revenue under legal agreement. This formalized structure ensures clear delineation of responsibilities and benefits amongst participating entities. The other definition of sourcing arrangement is defines an entity who sources loans or for another regulated entity. Funding regulated entity. So there is a funding regulated entity, and there will be a regulated entity which is only sourcing the loan customers and taking the loan customers to a funding regulated entity. So without risk or profit sharing, it is only business, and this arrangement focuses on customer acquisition without the sourcing entity takes on the credit risk. Now coming to the permitted regulated entities, we have already discussed. This is the definition of permitted regulated entities. Blended interest rate is the weighted average of interest rate charged by funding regulated entity, disclosed to the borrower via key fact statement. The key fact statement is also important, and this ensures transparency in pricing, and the customer must know that what is the sourcing cost of my NBFC and how much this NBFC is earning while giving loan to me. So that kind of weighted average of interest figure has to be disclosed to the borrower. Default loss guarantee is sourcing entity. The sourcing entity guarantees up to 5% of loan loss to the funding regulated entity as per RBI default loss guarantee guidelines, which came in 2023. Thus, a limited guarantee mechanism helps balance risk sharing while preventing excessive risk transfer. Escrow account is required, and there is a clear-cut mandate through these directions that all the amount will be received in escrow account for disbursement to borrowers. All the installments, all the recoveries which will be made in that escrow account, and that fund flow will be completely monitorable and possible to monitor. Customer interface is the entity which is interacting with the borrower for documentation, servicing, and also for grievance redressal. That is customer interface, and it must be disclosed upfront. Whenever a person takes the loan, he has a right to get the disclosure of the which would be the servicing interface, which will be the servicing regulated entity. Then lending services activities like customer acquisition, underwriting, pricing, recovery, and servicing. This is governed by outsourcing norms. These services, services from the operational backbone of the co-lending arrangement. CIC reporting, like the credit information companies, they would get the information from both the entities, may it be a fund providing entity or only sourcing entity or only servicing entity. The credit information companies must report individually to all the defaults. It is generally mentioned in the guidelines that every regulated entity will have a policy which will be a board approved policy, and that will cover internal lending limit, target borrower segment, due diligence criteria for partner entities, and customer service standards and grievance redressal. All this will be defined in the board policy, and the board policy will also say master agreement between regulated entity. A written agreement is mandatory between the co-lending partners, and that agreement must include clauses and terms and conditions, like whatever detailed terms and condition, borrower selection criteria, product line and geographic scope, and fee structure for lending services, and responsibility sharing and dispute resolution. All these agreements must disclose. And then the third is the loan agreement must disclose the name and role of each regulated entity, by maybe sourcing, funding, or servicing. Then customer interface entity and the grievance redressal mechanism. Any subsequent change in interface requires explicit borrower consent. Key factor statement is again one thing which is required for the compliance in the case of co-lending arrangement. There has to be a key fact statement in line with the RBI circular, which was given on 15th of April 2024. And that key fact statement must include blended interest rate, all applicable charges, and annual percentage rate regarding the computation. Now, the private sector lending based on the co-lending arrangement with NBFCs can claim priority sector lending classification for their respective share of credit as per RBI guidelines. Unrealized profit, this is regarding provisional. Any unrealized profit from the co-lending entities this will be deducted from the common equity tier 1. Common equity tier 1 is something which all the financial institutions and banks, they are supposed to maintain the common equity, which is a tier 1 common equity, then tier 2, and then tier 3. This is a core capital of the bank. So the CET1, common equity T1, is the core capital of a bank and forms the strongest and most loss absorbing layers of the capital. So in fact, the net owned funds until loan maturity. So these are some of the basic requirements of the RBI directions. So Ankit, at this moment, see, we can actually go to a further detail, but at this moment, we should now take up some of the questions, or even you can add your views about these directions, and how do you feel that it will be good for the economy, and also for enhancing the consumer loans or priority loans to those areas where active banking is not available. So it can be done through sourcing and servicing companies. Yes, Ankit.
So Mr. B.S. Rathi wants us to comment on, whether this regulation is required, whether it is too excessive, too controlling, or too much of a micromanagement of the sector. He wants our comment on that part.
So one, that this is not the new one. Earlier, it started in 2018. Then it was further improved in 2020, and now it is 2025. It is one that it is increasing the market size. it is extended to all India financial institutions. It is also extended to the sourcing and servicing companies, and also some kind of disclosure requirements which must be there to protect the interest of the investors or depositors. So therefore, this one, the impact of this particular direction would be that in one particular scheme, in one particular directions, the uh, entire journey is covered, right from the sourcing to disclosure. Everything is covered, and I have not seen, as compared to the past, that it is rather going to be more uh, control uh, is a subjective, or it is even not more compliance uh, focused. So this is something which is consolidating all the earlier things, and it is rather making it easier. Yes, Ankit.
So I think, yes, I also agree that this is forward looking, and I see that a lot of co-lending loans are actually in the market and in the retail space now. Somebody has the database these days, somebody has the technical understanding with respect to how to gauge and understand which customers to lend to. And this we call it 5 second loan. So somebody comes to a shop and that shop says that, oh, you don't have the money to buy this is a little expensive than what you thought you will like to pay. So we can immediately get a loan process uh, from NBFCs who are into this space. And then those companies would simply ask for the PAN. They would do a quick check on the CIBIL, quick check on the other information that they have with respect to that PAN, and they will release that loan. So there, a lot of banks and a lot of companies now then want to be part of that process. So they align with other NBFCs and actually do a co-lending arrangement where the risks are also shared. So I think this is also looking at controlling that avenue and kind of limiting the exposure of those entities to that kind of a process where they can be high risk of lending, such lending arrangements.
So any
So
other question?
nothing else that I have. In case somebody else has a question, they can raise their hand. They can.
I think there was one hand which was raised from some Koti.
I don't see anyone right now.
Okay. So now I think we can discuss something which is provided in these directions regarding policy framework requirement. So when the board is framing policy, when the board of each bank or NBFC or any regulated entity is framing policy, what the policy must state? The policy must be a board approved policy. It should be target specific, whether this policy is for agricultural loan, whether this policy is for MSME, whether it is for microfinance. So that kind of priority sector also must be very clearly defined in the policy. Then the partner selection, the due diligence, the criteria for the partners, and what kind of appraisal, what kind of precautions, that should also be there in the uh, policy of the bank or NBFC. Then customer service standards, because for any kind of customer servicing, there has to be some standards, and those standards are must, so that everyone would know that they have a kind of 1 hour time to respond. So that is something which is customer satisfaction standard. Then the policy says that the master agreement would be signed between the uh, co-lending partners. And the master agreement it must be a written agreement. It must have the selection criteria, selection of borrower. Selection of borrower criteria must be mentioned in the master agreement. Then scope definition, like the product lines and the geographic scope, must be clearly defined to prevent ambiguity in operational execution. Then fee structure must be defined, and responsibility sharing also must be defined in any kind of area that we are looking at. And then the loan agreement with the borrower, there has to be a board approved loan agreement with the borrower, and that loan agreement should also have some of the facts very clearly, like disclosure of participants. The loan agreement must clearly disclose the names and roles of each regulated entity involved in the arrangement, whether they are responsible for sourcing, funding, or servicing of the loan. So that is one, it's a very clearly defined process. Then customer interface identification. So it like this is to ensure and it be well serve the customers. And even if there is a breakage in the arrangement between the entity one and entity two, still the customer must get the interface and interaction. Grievance redressal mechanism must also be part of the loan agreement, and the consent for changing whenever everything, whatever is mentioned in the loan agreement as the entitlements or rights of the borrower, that would not be changed without the consent of that borrower. Then key factor statement. So Ankit, key factor statement is also something which is related to the disclosure norms. The RBI says that these are the basic facts which must be disclosed to the borrowers and also to the other regulated entity. One is the comprehensive disclosure, because the comprehensive disclosure regarding all facts must be there. Interest rate disclosure is also something which should go to the client, that the cost of funds for company A is 10 rupees and the company A is giving to the ultimately consumer of the loan is, say, after a profit of 5%, which is considered too high or whatever is considered too high. So that is where the interest rate discussion. Then fee and charges must be very clearly defined, and annual percentage rate also should be very clearly defined. Now, the priority sector lending, presently it is kind of, when I say that it is agricultural loans, supporting India, in fact, that's like any kind of farming community, in case they are getting priority, that will be considered as a priority lending. And in that priority lending, this regulation will be applied. Then is the MSME financing. MSME is like, again, we can have micro, we can have small, and we can have medium enterprises, which qualifies for PS1, which qualifies for PS1, helping expand access to the credit. Then housing finance is the other, especially when the affordable housing loans under co-lending arrangements can be classified as priority sector. That is also the priority sector lending eligibility. So, Ankit, like when we talk about the unrealized profit for NBFCs, then we talk about how the NBFC will acknowledge or have the profit in their financial statements. So, NBFCs must identify any unrealized profits arising from the co-lender arrangement. So, the unrealized interest must be kind of added or must be used for the purpose of calculating the tier 1 capital or calculating the otherwise CRAR calculation. Capital deduction, the unrealized profit should be reduced from the capital. Then duration, maintain the deduction until loan maturity to ensure capital adequacy. So in case there is a loan for about 36 months and then there is a default in 24, so still there is some profit which is unrealized. So that is something which is mechanism should be developed so that the all will make payment on time. And then NOF adjustment, deduct some of the own net funds. MOF means is the net owned funds. So net owned funds can be adjusted for certain things. It is provided that it can be adjusted. So we are not deliberating on this. So we will also have interest rate and other fee charges. So this blended interest, borrowers are charged a weighted average of rates from each funding RE based on their respective loans. Then fee structure, fee must be must follow a broad approval policy, be based on the objectives. So that is the approval they are asking for the management. From the management, they would need approval. Transparency means all fee charges and final blended rate must be included in the annual percentage rate, APR, annual percentage rate. It must be included that, and clarity is shown in the key documents. Operational arrangement, how the operational arrangement will be managed between the regulated entity. One is the lending entity, the other may not be lending entity, or the other may have a small share. So therefore, these directions are guiding that there will be a separate loan account in the books of the entities. So each regulated entity must maintain a separate account for its share of loan, ensuring clear accounting and regulatory compliances. Now, this separation is essential for proper risk management and financial reporting. Escrow mechanism is very, very important operational arrangement that all disbursement which comes from one entity to the other entity for the purpose of dispersing loan, that has to go through escrow account. And similarly, which can be one of the participating regulated entity. This ensures transparent fund flow and proper reconciliation. So this is what that we have as an operational part two. We actually will say the business continuity. When we say business continuity, that means that even if there is a gap, even if there is a breaking of relationship between two entities, but the operations must continue, and the business continuity must be defined in two documents. One is the document which is internal document, which is a policy, and the second is the document which is an agreement with the funder or agreement with the service provider. So therefore, all these operational things are supposed to be managed. Reporting to credit information companies like Fairfax or Sibyl, all this will be done independently by co-lenders and not will be piggybacking on the other one. It will be independently applied by the management of the any company which is in bad. So therefore, it is also important that information must be reported. So in the case of default loss guarantee, when we say a regulated entity which is only and only doing sourcing. Ankit, I think there are some questions. I will talk about default loss guarantee a little later.
So we have Mr. Kabir, Mr. ML Kabir, who says that if you could explain the change in the method of NPA classification. In other words, earlier institution NPA classification versus borrower level classification under the new policy of co-lending. So this is his question.
Now, even today, the RBI draft direction says that the NPA classification will be borrower-wise. It will not be institution-wise. And in the existing regulations, which were issued in 2020, it was also based on the individual borrower account. And it was not on a bouquet, it was not on a segment. So that is very clearly, there is no change. The only thing is that it would be, earlier also, it will be a software-based identification of NPA, software-based. So the software-based identification of NPA, these directions, in fact, came about a couple of years back. So every bank or NBFC, they have to now use a software, and based on that software outcome, the cases will be marked as NPA. So this is what is the Ankit.
So there is no change there. We are looking at borrower level classification.
Yes.
Now, then we have Mr. Kasi Visweswara Rao. He says that under the CLA mechanism, any laxity on part of any partner in the CLA may give rise to some kind of risk to every partner in the CLA. So in such cases, how does an RE not part of the cause of such a risk be protected or ring fenced?
Now, I think what you're saying is the
So there are
Again,
two partners in a CLA mechanism, let's say two or more partners. One partner or two partners have been diligent and they have been looking at all the documents, looking at everything very carefully. And let's say that the third partner is not so diligent. So I believe that you have to choose your partners carefully. There is no, if the loan
no
goes
one.
bad because of one partner's laxity, then it goes bad for everyone. We have seen other cases also where we have seen co-lending arrangement, or rather I would say that we see that one bank is the lead bank and the lead banker was not careful about stock or debtors, and ultimately that caused the loss of security to all the banks who were party to that borrowing.
So Ankit, we actually can conclude like this permitted limit for default loss guarantee. Now this means the regulated entity as a sourcing or funding entity may provide a default loss guarantee of up to 5% of the loan portfolio outstanding under a common lending arrangement or sourcing arrangement. So they actually uh, they can take only 5% of the default loss guarantee. Like in case they will disburse 100 to a customer, and out of that 100, the entire amount is now given by a larger NBFC or taken from the bank, and then in that case, the so this is the 5% loss clause is now added. That is also it is not mandatory. It can be a default loss guarantee can be 5%, and it is also possible that it is only purely service based. So it is may provide a default loss guarantee of up to 5%, and that is also without providing any funding to the borrower. So the governance, when we say the governance, the default loss guarantee must follow RBI's default loss guarantee guidelines of June 8, 2023. Now, the restrictions on default loss guarantee by non-RA, RE or other unpermitted entities is not allowed. So that is not allowed. The default loss obligation of 5% can only be taken up by regulated entities. So this is the pani. Then asset classification norms, as the question came, the borrower level classification, asset classification, like the special mention account, non-NPA, shall be done at the borrower level across all regulated entities under the common loan arrangement. If one resolution applicant, in case one regulated entity classifies a loan as NPA, the others must follow the same classification. That is also very important. And then one is the automation, as I said, that in September 14, 2020, all the regulated entities, they were actually told that they have to bring a software which will be used only for the entities which are only for the borrowers which are actually see this is the borrower wise classification of NPA is must, and also the provisioning requirement is automatic. So that automatic provisioning requirement was wide RBI's circular dated 14th of September 2020. Yes, Ankit, I think I can see some questions.
So we have Prashant Chaudhary ji asking that what about the applicability of PLR mechanism strategically, and what about ensuring entire exposure to the borrower?
What is PLR mechanism? I think we need to understand from him. What is PLR mechanism? I think what we are saying is the co-lending arrangement that we are talking about. Co-lending arrangement is CLA. CLA arrangement is something that we are covering today.
So yes, I believe PLR is. We can check with
See,
him.
the
I
PLR
think
is
it
the only
might be.
priority lending. The
Yeah.
priority lending, as I said, it is the farm sector, it is the MSME, it is microfinancing. These are priority lending. And also there are some other segments which RBI keep declaring from time to time. That is what is priority lending. And even this particular directions are primarily, it is focused on priority lending segments only, but now it is open to all segments The only thing that is not permitted is anywhere where the total consortium or individual loan is more than 100 crore, then co-lending, then this draft regulations, then directions would not be applicable.
We have a raised hand from Mr. Ranjan. Maybe I can ask him to talk. Ranjan, you can unmute yourself and share your question. You're not audible to us.
Am I audible, sir? Now?
Audible
Yes,
now.
yes.
Yes, sir. Sir, is there any provision for subsidized rate of interest for priority sector lending here?
See, the priority sector lending rates are normally subsidized because the banks are under obligation to give priority sector lending.
That's
However, when the
governed.
banks,
That's already governed by separate systems within RBI. I think this particular direction will not deal with the subsidization. But yes, there is
yes,
subsidization in MSME loans. There's subsidization in other schemes as well.
yes. And this subsidization, in fact, comes because of lower compliances like statutory cash reserve ratios, and those are not applicable or lesser applicable to priority sector lending. Therefore, the banks can afford to extend priority sector loans at concessional rates.
Right then. So yes, I think that takes care of that question hopefully. And
So I think
how? Yeah,
there are
I
some
think we can.
directions. Yes, Ankit.
No, you go ahead, please.
So these directions covers transfer of loan exposures. So one is the regulatory compliance. So the any transfer of loan exposure under co-lending arrangement must comply with the RBI master directions, which is called transfer of loan exposures, and that is dated 24th of September 2021, and that is mentioned in these directions that any transfer of loan would be according to those directions. Then any transfer of loan would require mutual consent of both the parties. And documentation standard, any kind of proper documentation of all transfers must be maintained to ensure regulatory compliances. And then the again, when we talk about the pure outsourcing permitted. Now, the regulated entities may engage another regulated entity or even a non-regulated entity to source a loan or service a loan. That is also covered by these directions. So there has to be a clear agreement between the service provider, between the lending regulated entity and servicing regulated entity. There has to be a clear agreement. It should be arm's length terms and conditions, and the funds remittance from the service provider. It has to be only on the actual receipt from the borrower, only on the actual receipt of the borrower. Because see why this has come, because the RBI might have noticed that some of the service providing regulated entities, to avoid account becoming NPA, in fact, were giving kind of collection which has not actually come from the customer. So that is where some kind of regulations were required. So therefore, they have said that it cannot be remitted, funds cannot be remitted to the funding regulated entity till the time it is received from the borrower. So then there are disclosures requirements, like website disclosures are required, financial statement disclosures are required, and also by these directions, the earlier circular dated 5th of November 2020, that will be repealed, and the all this otherwise, because there is a transitional provision, regulatory oversight, all this is clear that the regulatory oversight would be there, and the loans already sanctioned under a repealed circular shall continue to be eligible for priority sector classification until their repayment or maturity, whichever is earlier. So the implementation says the regulated entity will need to align their existing co-lending arrangements with the new directions within the specified transition period to ensure full compliance. That is what is all in this master directions, which are draft for the time being. So in case there is any question, or otherwise we can conclude.
I don't see any other question, so we can conclude. And
so thank you very much. Thanks a lot. And we would be coming with a video by the end of the day today. One, the video for this particular webinar, and other that we are also coming up with a video for the yesterday judgment on Bhushan Power. That video we are also making, and it will be given to everyone by the end of the day today, so that everyone's understanding about that Bhushan Power fiasco, what has happened. Thank you very much. Thanks a lot.
thank you all. Thank you, everyone.